So recently, there's a lot of buzz surrounding Bitcoin, and it's not hard to see why. Bitcoin has just hit all-time high recently, while overtaking Amazon as the 5th largest asset in the world. More countries are holding onto Bitcoin now. Institutions are increasingly buying into it. It was even believed that Bitcoin could one day replace the US dollar as the reserve currency. But does this mean you should invest into Bitcoin before it goes up even further? Or is it just another speculative asset that will give a boom and crash one day? In this video, we will be looking at the premise of investing into Bitcoin. What are its bull and bear cases? Then finally share my thoughts on it. When Satoshi first created Bitcoin, it was originally meant to be a peer-to-peer electronic cash system, a way for people to send money directly to one another without going through banks or payment processes. The goal was to create a form of digital money that was borderless, resistant to censorship, and independent of any central authority. Yet, despite this vision, Bitcoin's actual transaction activity has not grown significantly over the years. In fact, data has shown that the network has plateaued in terms of transaction count after it peaked in 2024. Indeed, instead of being used for its original intended purpose, Bitcoin is increasingly being viewed as a store of value and as an investment to speculate on future price gains. Just ask any Bitcoin investor and they'll be like, "Siao, why would I use Bitcoin to buy anything when I can hold it and what big?" The idea behind this is simple. There will only be 21 million Bitcoin ever in existence. So far, about 95% of it has already been mined. As demand for it goes up, the price should go up as well. However, there's just one problem. Bitcoin is not an income-producing asset. As Warren Buffett once put it, buying Bitcoin is not an investment because it lacks intrinsic value. When you invest into Bitcoin, you are just hoping the next guy pays more. You aren't investing. When you do that, you are speculating. This is also why Warren Buffett famously called Bitcoin rat poison squared, while his business partner Charlie Munger described it as disgusting and contrary to the interests of civilization. But wait, doesn't the same principle apply to stocks? After all, when you buy into stocks, you are also hoping that their price will go up. Well, not really, because unlike Bitcoin, a stock represents an ownership in a company. The company produces goods or services, earns profits, and as their earnings go up over time, so does their stock price as well. In other words, stocks have an underlying business that generates value, while Bitcoin's value is derived purely from supply, demand, and market sentiment. Okay, in that case, why are all these institutions and governments investing into red poison, Bitcoin then? The short answer is, many of them see Bitcoin as an alternative asset class to protect their wealth against inflation. Take the US for example. Since 1990, the average inflation rate has been around 2.5%. Over a 35-year period, a $100 bill would now only have a purchasing power of $42. In other words, that money has lost close to 60% of its value due to inflation. This is all thanks to the expansion of money supply, largely caused by money printing. Here's an image I found online. What it's trying to say is that instead of thinking that Bitcoin is going up against the dollar, perhaps it's better to think of the dollar value depreciating against Bitcoin. But still, this doesn't explain why Bitcoin is chosen and not some other asset classes. After all, there are many inflation hedges like gold, real estate, commodities, and even certain stocks to choose from. Perhaps what makes Bitcoin stand out is its unique combination of absolute scarcity and portability. Unlike gold, Bitcoin can be moved across the world in minutes for minimal cost. Unlike property, it is highly divisible and doesn't require maintenance. And unlike stocks or bonds, Bitcoin is not tied to the performance of any single company or government. I'm sure some of you might remember the bond scare when US long-term treasury yields surged about 54 basis points, marking the biggest 3-day rise since 1982. It was a stark reminder that even the so-called safest asset class in the world, US treasuries might not be that safe after all. And it is movements like this that have led many once skeptical wisers to reconsider Bitcoin. Ray Dalio, the legendary hedge fund manager who once called Bitcoin a bubble, later admitted that it had a place in a diversified portfolio as digital gold. Larry Fink, the CEO of BlackRock, went from calling Bitcoin an index of money laundering to launching a spot Bitcoin ETF and calling it an international asset. Same for Howard, who predicted that Bitcoin is more likely to be $100 than $100,000 is now quietly investing in Bitcoin. Heck, even pension funds are buying into Bitcoin now, with half of the advisors planning to recommend cryptocurrency investments to their clients within the next 12 months. Now, before I sound too much like a Bitcoin salesperson, let me just say this. The idea of using Bitcoin as an inflation hedge is not without its flaws. First, while many people see inflation as an evil thing, it is important to understand that inflation can actually be a sign of a healthy and growing economy. Despite often being ridiculed, the Federal Reserve often uses controlled inflation as a tool to encourage spending and investment, which helps fuel economic growth. If anything, the inflation that we have today is one of the lowest we have seen in history. In fact, many prominent economists support this strategy, recognizing that some inflation is perhaps the lesser evil compared to deflation. Historically, contractionary policies aimed at aggressively reducing inflation, like sharply raising interest rates, have often worsened economic downturns, while leading to higher unemployment and slower recovery. Besides that, another flaw of Bitcoin as an inflation hedge is its high volatility. Unlike traditional assets such as bonds or blue chip stocks, Bitcoin's price can swing dramatically, sometimes moving 10 to 20% in a single day, and at times even dropping by up to 90%. This level of volatility makes it a risky option, especially for those who are relying on it to store their wealth. Bitcoin's price has shown a relatively high correlation with the broader stock market, particularly the Nasdaq. This can limit its effectiveness as a true diversifier or safe haven. That said, it's worth noting that Bitcoin's volatility has been gradually declining over time. As the market matures, trading volume increases, and institutional participation grows, price swings have become less extreme compared to its earlier years. While Bitcoin's decentralized nature is one of its biggest selling points, it is also one of its biggest downsides. Unlike a bank, there's no customer service hotline to call if you forget your password, lose your private keys, or send the funds to the wrong address. Once a transaction is confirmed, it is irreversible, whether it is a simple typo or scam, and people have lost millions of dollars due to this. On top of that, there's no insurance or regulatory safety nets protecting your Bitcoin holdings. Unlike traditional bank accounts, which are often insured by government agencies up to a certain amount, most crypto exchanges offer no such guarantee. Furthermore, there have been multiple high-profile cases where crypto exchanges misuse or misappropriated client funds, sometimes trading them without authorization. These incidents have led to massive losses for investors and, in some cases, the collapse of the exchange itself. This lack of a safety net can make it intimidating and risky for the average user, especially those used to the customer protections offered by traditional finance. That said, this flaw can be easily sidestepped by just going for Bitcoin ETFs. This allows investors to gain exposure to Bitcoin price movements without having to worry about managing private keys, securing wallets, or deal with the risk of unregulated exchanges. But perhaps the biggest flaw of them all is that there's really no real way of determining Bitcoin's value, though that hasn't stopped people from developing various models to try and estimate it. Some rely on the cost of mining Bitcoin, arguing that the energy and resources required to produce each coin set a floor for its value. Others use the stock-to-flow model. This measures the scarcity of Bitcoin by comparing the current supply against the annual production, suggesting that Bitcoin's value should increase as its supply becomes more limited. Then there's also the power law projection, which attempts to forecast Bitcoin's growth based on adoption rates and network effects. While all of these models have so far been able to predict Bitcoin's price to some degree, it is important to remember that past performance doesn't guarantee future results, especially given Bitcoin's short 16-year track record. So with that all being said, is Bitcoin a good investment? The answer really depends who you ask. If you ask the Nobel laureate Eugene Fama, he will tell you that Bitcoin will become worthless within a decade. On the other hand, someone like Michael Saylor believes Bitcoin could one day reach $10 million per coin. Meanwhile, Fidelity thinks that adding a small allocation to Bitcoin can help to boost overall returns without increasing risk by much. BlackRock shares a similar view. Ultimately, no one really knows where Bitcoin's price will go from here. As of now, Bitcoin remains a highly speculative asset, full of uncertainty and volatility. And because of that, I choose to only invest an amount I'm comfortable with losing. If it goes to $10 million, then voila! But if it goes to zero, sure, I will cry to sleep for a few nights, but it won't ruin me. However, if there's one advice that I would give, it is this. If you do decide to invest in this Bitcoin thing, do not get overconfident if the price goes up. A higher price doesn't automatically mean it's a good investment. For all we know, it could just be hype or speculation driving the market. On the flip side, don't panic or sell out of fear when the price dips. Emotional decisions such as fear and greed often lead to poor outcomes in investing. Instead, the most successful investors are those who stay disciplined, keep a clear head, and focus on their long-term goals rather than reacting to short-term market swings. At the end of the day, investing in Bitcoin or any asset requires patience, risk management, and a willingness to accept uncertainty. If you keep those principles in mind, you will be better to position to navigate the ups and downs of this volatile market. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every week.